Hello, everyone. I am Michael Ruger. I am the managing partner of Greenbush Financial Group. The topic we're going to be discussing today are the new mandatory Roth 401k catch-up rules. We are a few months away from the launch of these across all of 401k, 403b, 457b plans. So this is a new rule starting in January 2026 that's going to require a lot of prep work from employers, from employees to know that their tax situation could change because they might have been doing pre-tax catch-up contribution before, but depending on their income threshold, they may now be required to do those catch-up contributions in Roth. We have been anxiously awaiting guidance from the IRS on a number of questions that surrounded these new mandatory 401k Roth catch-up rules, and we just received that guidance a few months ago from the IRS. So in this video, I'm going to cover, a general overview of the new mandatory 401k catch-up contributions. I'm also going to cover the income threshold for employees that will be impacted by this new rule, the definition of wages that was just clarified by the IRS for this income threshold. Will this apply to simple IRA plans as well as 401k plans? There's a first year of employment exception within this new rule. And will 401k plans be required to adopt Roth deferrals prior to January 2026? A quick overview as to what this new mandatory Roth catch-up contribution provision is within 401k plans. So this was enacted in 2025. The effective date of this is actually January 2026. So we're 2025, everything's unchanged. Going into 2026 is when this rule goes into effect. But if it was in effect for 2025, when you contribute to a 401k plan, the regular deferral limit is $23,500 this year. But if you're age 50 or older, then you get to do the catch-up contribution, which is $7,500 this year. Now, in the past, employees could decide whether they want to do that catch-up contribution pre-tax, Roth, or some combination of the two. But in 2026, that's going to start changing depending on what the comp of that employee was in the previous calendar year. And the line item is $145,000 in wages is where they draw the line to say if you're below $145,000 in wages with that employer in the previous year, you can continue to do your catch-up contributions pre-tax if you want. If you find yourself above that wage threshold, then going forward, starting in 2026, you'll only have the option to do your catch-up in Roth. The reason why that's unwelcome news for higher income earners is typically higher income earners want to put as much as they possibly can pre-tax in these plans to lower their tax liability for the year. They'll still be able to do their 401k deferral piece, but now it's taking away a good chunk of change that they were able to defer in these plans pre-tax, and now it's going to end up being taxable income to them going to the Roth source in years going forward. The first item that the IRS came out to define in the new proposed regs that were issued in 2025 was the definition of wages. And the definition of wages ended up being compensation that they assess FICA tax against. So we're talking about W-2. That was our big question as to this $145,000 threshold. Would it apply to, when you say wages, that's W-2, but if you have a self-employed individual who's, let's say, a sole proprietor or partnership getting a K-1 and they're making $200,000, $300,000, does that apply to those individuals as well? And the IRS came out and said it only applies to employees that have wages, so just W-2 employees. If you have a partner at a law firm that has a K-1 and they get $400,000, according to these new proposed regs, they will be able to continue to make their catch-up contributions to 401k pre-tax in 2026 going forward because technically they don't have W-2 wages. The IRS also clarified the first year exception rule for new employers that are hired by a brand new company. So the way it works is they are looking at the wages for the previous calendar year to determine if this restriction will apply in the current plan year. So if you think about someone who's hired new for a company, let's say July 2025, they didn't have any wages with that employer in 2024. So essentially they don't put that restriction. So even though that employee may make more than the wage threshold in 2025, they can still do their catch-up contribution pre-tax because there were no wages in the previous year. So it's not like the employee has to go back and say, well, with my former employer, I was over the threshold, so then I can't do my catch-up contribution pre-tax this year. It goes just by the employer that you're working for now. Now, some employees that are over that $145,000 threshold for their W-2 will get a 2-year pass in these rules depending on when they were hired by the employer and when they earn that money. So let's say I have an example, an employee that was hired at a $200,000 salary. But if they were hired in July of, let's say, 2025, there were no earnings for the previous year, so already this year they get a pass. They can do all of their catch-up pre-tax, but then when they're in their 2026, their first full year of salary, where they're getting their first full 200 grand, the employer is going to look at 2025, and since they only earned half of their salary, basically July to December 31st was 100 grand. Even though they made 200 grand in 2026, they can still do their catch-up pre-tax because they're going to be looking at their half-year salary in their first year that they were with the company. So they essentially get a 2-year pass. The IRS also clarified another important item, that Roth deferrals are not available in all 401k plans. They're actually a voluntary contribution type that each company has to elect into their plan. And the way the regulations were initially written was if a 401k plan did not allow Roth deferrals, that means all employees, regardless of how much they made, were precluded from making any type of catch-up contributions to the plan, which didn't seem great. But under the new proposed regulations that they just came out with in January 2025, they said, okay, if a plan does not allow Roth deferrals in their plan, which again is voluntary, any employees $145,000 in wages or below would still be allowed to make catch-up contributions, but any employees $145,000 or above in wages would be precluded from making catch-up contributions if the Roth source is not available in the plan. There was also welcome news for simple IRAs in the new proposed regs that they specifically said, hey, these new mandatory Roth catch-up contributions apply to just qualified plans like 401ks, 403bs, 457s. They specifically do not apply to simple IRA plans that also have an employee deferral and catch-up component, which means if a company sponsors a simple IRA plan and they have employees making wages over $145,000, those employees can continue to make their catch-up contributions pre-tax to those simple IRA plans, since these new rules don't apply to those type of plans. I hope this information was helpful. If you have any questions, please feel free to reach out to me at greenbushfinancial.com. Thank you.